Okay, Professor Jim Schultz here from my Finance 512 class. I wanted to go ahead and shoot our first video of the semester. And I wanted to go ahead and kind of do a couple of things. So, first of all, I wanted to show you guys, kind of how to trade some of these vertical spreads that, that we've talked about in class. And so, the company I want to look at today is Amazon. So AMZN, they actually have their earnings call tomorrow. And so I trade Amazon pretty regularly. I watch this company on a fairly regular basis. And so I wanted to kind of show you guys how you could potentially, use these vertical spreads surrounding options or use these vertical spreads surrounding earnings to kind of put on some option strategies around these earnings calls. Now, Amazon's earnings call is not till tomorrow after the bell, and so if you don't watch this video until tonight, you could still do this strategy tomorrow. Okay, so I've got Amazon pulled up here, and you see all the options that are kind of at your disposal. And so I would go ahead and just use the front month, which right now would obviously be November because it is Wednesday, October 22nd. So let's pull up the front month, which is November, and you see Amazon is currently selling for $315. And so what I want to do right now is I want to just minimize the number of strikes I'm looking at to make things a little easier. So let's say I'm looking at 20 strikes. So then Thinkorswim is going to take the 20 strikes that are around at the money because those are going to be the most actively traded strikes. Now, in our next class period, we're going to talk about, we're going to talk a little bit more specifically about strike selection. But right now, I really just want to go through the mechanics of how to put on a vertical spread in a stock. So let's say that you've concluded that you think that Amazon is going to disappoint in their earnings call tomorrow. So you want to be bearish on Amazon. As we've learned in class, there's essentially two ways that you can do that with vertical spreads. You could either do a bearish vertical call spread, or you could do a vertical put spread. So basically, you're either going to be, if you do a vertical call spread, you're going to be selling that call spread because you want a short call spread, which will profit if the stock price goes down. If you do a put spread, you're going to buy that put spread because that will profit if the stock price goes down. And so this stuff is very confusing with, long call spreads, long put spreads, short call spreads, short put spreads. But after you do it a few times, you start to kind of get accustomed and a lot more comfortable with what you're trying to do. All right. So let's say I want to do a short call spread. So remember, that's going to involve selling a call and then buying a higher striked call. Okay, so let's say, and again, remember, I'm going to show you guys a lot more about strike selection next week. Well, let's just say I want to sell this 320 call and then buy this 325 call. Okay, this is going to be my short call spread. So I would click on the bid on the 320 call, and then the order box that you guys are already accustomed to comes up. But let's say that you want to combine that with that 325, or actually, hang on a second. I was on the put side, so let me delete that. I want to do the call side. So if that was confusing because I was using puts, it should have been because I should be using calls. And so we want to be on the call side, which is over here. So I want to sell this 320 call for $11.80. So boom, I click on the sell. So now what I would like to do is I want to go and I want to combine that with this 325 call that I want to buy. If you hold down the control key and then click on this buy on the 325, boom, you see you now have both of these going in as one order. Okay? And so this is really cool. This is how you want to do a vertical spread. And you can see Thinkorswim already picks up on the fact that you are trying to do a vertical spread. And so these two orders will get filled together. Okay? And so if I want to just do one contract, make sure that that's one contract. I'm selling the 320 call, I'm buying the 325 call, and I'm going to collect a credit of 211. So you're going to collect a premium of 211, which makes sense because this is a short call spread. So I'm going to sell the November 320 call for $11.75. Then I'm going to buy the 325 call for $9.85. And when you net those two guys together, that comes out to about 211. And so, or 212. It's obviously floating as the market floats. Okay? And so what I'm going to do is I'm going to do confirm and send. I'm going to lock that guy down so the price doesn't change. I want 211 on this guy. So I'm going to do a confirm and send. And then I'm going to go ahead and ship that guy. And let's see if it'll fill right away. Okay, so here's another interesting thing about kind of how to get your orders to fill. So right now I want 211 for this vertical spread in Amazon. That's the mark price right now. If you click on cancel replace, so 211 apparently is too high to get an immediate fill. So tick that guy down by a penny. Now if you only took 210, let's send that guy in. And let's see if that'll fill right away. Okay, so it filled right away. It actually filled, apparently it filled at 211. And so let's see, if I go to my account statement, the reason why it got rejected, I think, is because as I was clicking send, it went ahead and had already filled in that millisecond. So if I go to account statement and I look at my trade history, you can see that, hey, I actually got 215. So you can see I've been trading oil futures too, but you can see that on this Amazon trade, I wanted 211, but it actually got filled at 215. Why is that? It's because of high frequency trading. That's why. It's because there were all these high frequency traders out there that were bidding for my orders that we talked about in class, that I ended up getting a better fill than I originally even wanted, right? And so score one for the high frequency traders. So that's one way that I could be short Amazon going into tomorrow's earnings call using options. Here's the other way. Now suppose that you wanted to buy a put spread. So now what I'm going to do is, and I kind of briefly covered this in class. We didn't cover this a lot. I was hoping that from going through the call spreads in great detail, you guys would be able to kind of figure out what you need to do on the put side. So let's say that with Amazon currently trading at about 314, I'm going to buy the 310 put, which is going to be over here. Again, I wanted to be on the call side and I was going to mess that up again. But now I'm on the put side. So I'm going to buy this 310 put for $12.55. And I want to sell the 305 put. So once again, how am I going to do that? I'm going to hold down control and click sell. And so you see, once again, Thinkorswim is figuring out that I want to do a vertical spread. And this is going to be a long put spread. So I only want to do one of these guys. And so I'm buying the 310 put. I'm selling the 305 put. Remember, I'm buying this put spread, so I have to pay. There's going to be an outflow for me to get this put spread to fill. It's completely different. It's the exact opposite than if you're selling a spread. That is, I just sold that call spread for $2.15. That's the most I can make on that position. What's the most I can lose? Remember, it's the difference in the strikes minus the credit that I received. So on that Amazon call spread that I just sold, the most I can lose is $2.85. The most I can make is $2.15. And I just realized that I am now disconnected, and so that's not terrific. All right, so I am reconnected, and we're back where we left off. And so let me go ahead and do this long put spread again. So again, I'm going to buy the 310, and I am going to sell the 305. There's my vertical. I only want to do a one lot. And the current market price for that is 205, 204. That's fine. I'll lock that down. Let's go ahead and see if we can get filled at 204. If not, we'll do a little price discovery until we get filled. And so working order 204. The mark is just under 203. Amazon's not a super liquid stock, and so sometimes it's difficult to get fills in here. And so sometimes you have to kind of pay a little bit more or be willing to take a little bit less. And so I want to go ahead and I'm gonna penny this up until I get filled, which is just a good strategy for trading. So boom, there you go. We got filled at 205. And so now I am actually, I just really was doing this for the video. I'm not necessarily bearish on Amazon tomorrow. I'll have to figure that out tomorrow. But I just kind of wanted to show you guys, how you can how you can execute two different bearish strategies for a stock, around earnings. And so if you see Amazon, if I click on where I'm at on Amazon, I have this short call spread and I have this long put spread. Now let me make one quick comment to close out this video. Let's say that, like, for example, if you look at the call spread, you can see that well, if you look at the call spread, let's say I only had this call spread, right? And let's say I was making money on this call spread, and you wanted to go ahead and square this guy up and get out of it. Here's something that's really cool on Thinkorswim. You can highlight these two orders, and then right-click and create closing order. You're gonna buy this vertical back. So remember, what did we do? We sold the 320 call, right? So I sold. That's why you see a plus. I sold the three. Well, let me start again. I originally sold the 320 call, so I've got to buy that guy back. That's why you see a plus there, because you're buying the call back that you originally sold. You originally bought the 325 call, so you've got to sell that guy, right? So this would get you out of this position. This is how you would square up this short call vertical spread. So hopefully this was a helpful video for you guys in kind of starting to trade options around earnings calls.